Federal budget is a summary of the federal government's proposals for spending, taxes, and the deficit. The fiscal year runs from October to October. The budget for fiscal year 2020, for example, is applied from October of 2019 to October of 2020. The reason for the fiscal year beginning and ending in October coincides with when the United States Congress is in session. A budget fiscal year applied from October to October allows Congress more time to arrive at an annual budget each year. A balanced budget is a budget in which tax revenues equal government spending. A budget surplus is the amount by which the tax revenues exceed government spending. A budget deficit is the amount by which government spending exceeds tax revenues. Note, the deficit is the negative surplus. Hence, a budget deficit of $100 billion equals a budget surplus of negative $100 billion. The budget that the president sends to Congress is a proposed budget. This budget is still debated and revised by Congress. After modifications, the budget is passed by Congress and sent back to the president to sign and enact as law. The enacted budget is usually slightly different from the proposed budget. This figure illustrates the difference between the proposed expenditures, revenues, and deficit versus the actual expenditures, revenue, and deficit that occurred for the fiscal year 2004 budget. From the figure, we can see that the revenue was lower than expected while expenditures were higher. As a result, the budget deficit was larger than expected. This figure illustrates how the fiscal year 2005 budget moved from proposal in 2004 to completion in October of 2005. The same budget cycle happens every year. This table contains the summary of the federal budget for the fiscal year 2004. The largest source of the federal tax revenue is personal income taxes, followed by payroll taxes and corporate income taxes. Sales taxes, under the category Other, are the smallest component of tax revenues for the federal government. The expenditure side of the budget can be placed into two categories. Category number 1, purchases of goods and services, like defense, and category number 2, transfer payments, like Medicare and Social Security. Purchases of goods and services are part of government expenditure that involves new production. This accounts for less than 40% of the government budget. Transfer payments are part of government expenditures that does not involve new production. It involves, rather, transfer of funds from the government to individuals without anything in exchange. This accounts for more than 60% of the government budget. Federal debt is the total amount of outstanding loans owed by the federal government. Whenever the government experiences a surplus, and the surplus is used to pay the debts, then the federal debt decreases by the amount of the surplus. If the government is in deficit, the federal debt increases by the amount of the deficit. This figure illustrates the relationship between debt and deficits/surplus in the United States since 1955. Note that the federal debt declined in 1998 when the federal government experienced a budget surplus. A debt to GDP ratio is the total amount of outstanding loans the federal government owes divided by nominal GDP. This figure illustrates the debt to GDP ratio for the United States between 1950 and 2005. While the total debt of the government is at its highest ever, the debt to GDP ratio is much lower than in 1995. An increase in government purchases will result in an increase in GDP, while a decrease in government purchases will result in a decrease in GDP, holding all else constant. Since the objective of fiscal policy is to get the economy back to potential GDP, fiscal policy requires that spending be increased when the economy is below the potential GDP and spending be decreased when the economy is above the potential GDP. This figure illustrates the situations when government spending is used. In the top panel of the figure, the GDP is below the potential GDP. An increase in government purchases will shift the 80 curve to the right and bring the GDP toward the potential. In the bottom panel of the figure, the GDP is above the potential GDP. A decrease in government purchases will shift the 80 curve to the left and bring the GDP down and toward the potential. A decrease in taxes will result in an increase in GDP, while an increase in taxes will result in a decrease in GDP, holding all else constant. Taxes should be decreased when the economy is below the potential GDP, and taxes should be increased when the economy is above the potential GDP. This figure illustrates the situations when higher or lower taxes should be used. In the top panel of the figure, the GDP is below the potential GDP. A decrease in taxes will shift the 80 curve to the right and bring the GDP toward the potential. In the bottom panel of the figure, the GDP is above the potential GDP. An increase in taxes will shift the 80 curve to the left and bring the GDP down and toward the potential. Countercyclical policy is a policy designed to offset the fluctuations in the business cycle. This figure illustrates the effect of a well-timed countercyclical policy. If the economy is expected to experience a recession, a well-timed countercyclical policy will reduce its size and bring real GDP back to potential GDP more quickly. A poorly timed fiscal policy would create wild fluctuations in the economy before bringing the economy back to potential. This figure illustrates the effect of a poorly timed fiscal policy. Here, government purchases are increased, but the response is too late. The increase occurs the year after the recession, during the recovery. It causes a boom, which could cause inflation to increase. Discretionary fiscal policy is changes in tax or spending policy requiring legislative or administrative action by the President or Congress. Examples of discretionary fiscal policies are 1. The 1968 temporary tax surcharge during the Vietnam War, 2. The Reagan tax cuts in the early 1980s, and 3. The Economic Growth and Tax Relief Reconciliation Act of 2001, which lowered income tax rates and increased tax exemptions for married couples and children. Automatic stabilizers are automatic tax spending that occur over the course of the business cycle that tend to stabilize fluctuations in real GDP. A tax on income is an automatic stabilizer because, as the economy is in recession, the tax receipts that the government collects decrease, while the tax receipts collected in a growing economy increase. There is debate among economists on the usefulness of automatic and discretionary fiscal policy. Critics of discretionary fiscal policy emphasize that lags occur in the economy, making discretionary policy harmful. There are 3 types of lags. 1. Recognition lag. 2. Implementation lag. And 3. Impact lag. Recognition lag is the time between the need for policy and the recognition of the need. Implementation lag is the time between the recognition of the need for policy and the time a policy is implemented. Impact lag is the time between a policy is implemented and the time its impacts are seen in the real GDP. Structural surplus is the level of the government budget surplus under the scenario where real GDP is equal to potential GDP, also called the full employment surplus. This figure illustrates how the structural surplus is determined. The figure also illustrates the difference between the structural and the actual surplus in a recession year. The structural surplus is above the actual surplus when the economy is in a recession, as tax revenues decrease and government spending may increase.